I need you to stop what you're doing right now. Pull up your bank account. Look at that number. Now let me ask you something nobody has ever asked you before. What if that number is actually hurting you? What if the bigger that number gets, the more money you're actually losing? I know, that sounds completely insane. But by the time this video is over, you're going to feel genuinely angry, not at me, at your bank, because they have been quietly getting rich off your fear, and you had absolutely no idea it was happening. Stay with me, because what I'm about to show you changes everything. What's up, everybody? Welcome back. If you're new here, my name is Smith, and I spend a genuinely embarrassing amount of time thinking about money, inflation, and why most Americans' financial strategies are completely, totally, 100% backwards. And today, we are going deep. We are talking about something that sounds so backwards that when I first heard it, I literally laughed out loud. The idea that keeping too much money in your bank account is one of the worst financial decisions you can make. Now, before you click off thinking I've lost my mind, I want you to give me just 5 minutes. Because I am going to show you real numbers, real math, and a real strategy that the wealthy have been using for decades, while the rest of us sit here feeling proud of our savings account balance. And hey, if by the end of this video, you think I'm wrong, tell me in the comments. I genuinely want to hear it, but I'm willing to bet most of you are going to finish this video and immediately move some money around. Let's get into it. Okay, so here's what's actually happening to your money right now while you are sleeping, while you're at work, while you're watching this video. There is a silent thief working 24 hours a day, 7 days a week, 365 days a year, stealing from your bank account. And that thief has a name. It's called inflation. Now I know. You've heard about inflation before. You're probably already rolling your eyes like, yeah, Smith, prices go up. Got it. But I don't think most people truly understand what inflation is actually doing to their specific dollars. So let me make this really, really concrete for you. The Federal Reserve has a target inflation rate of 2% per year. Just 2%. Sounds tiny, right? Here's what that actually means. If you have $10,000 sitting in a traditional savings account, earning maybe 0.5% interest, and inflation is running at 2%, you are losing 1.5% of your purchasing power every single year. That $10,000 today? In 12 months, it has the buying power of $9,850. Smith, that's only $150, big deal. Okay, fine. Let's zoom out. In 10 years at that same rate, that $10,000 has the purchasing power of about $8,600. You lost $1,400 in real value, while the balance in your account actually went up slightly. How is that even possible? Because your bank is paying you 0.5%, while inflation takes 2%. You're running on a treadmill that's moving backward. And here's where it gets really painful. Let me give you some examples you can actually feel. A Chipotle burrito. And I know we all love a Chipotle reference. That was $8 just a few years ago. Today? Try $12, $13 in some cities. The median price of a new car? Jumped from $38,000 to $48,000. A median home in America? We don't even have time to get into that one. The point is this. Everything you buy is getting more expensive, and your savings account is not keeping up. That comfortable feeling you get looking at your bank balance? That's not financial security. That is financial anxiety dressed up in a Halloween costume pretending to be responsibility. And your bank loves that you feel that way. We'll get to why in a minute. But first, let me show you the actual number. The exact dollar amount you should never exceed in your bank account. All right, here it is, the magic number. Financial experts, and I'm talking about people who manage millions of dollars for a living. They almost universally agree on this. You should keep between 3 to 6 months of living expenses in your bank account. That's it. Now notice what I said. Living expenses, not living income. Expenses. So if your monthly necessities, Rent or mortgage, groceries, utilities, insurance, minimum debt payments. If all of that adds up to $4,000 a month, your emergency fund should be between $12,000 and $24,000. That is your number. That is the ceiling. Everything above that amount is excess cash that is slowly, quietly, painfully losing value. Now I know what some of you are already thinking. But Smith, what if I lose my job? What if there's a recession? What if the economy completely collapses and society breaks down and I need to live off my savings for 3 years? And look, I hear you. I genuinely do. But here's the honest truth that nobody wants to say out loud. That kind of thinking isn't financial prudence. It's financial anxiety dressed up as responsibility. Real emergencies are almost always smaller than you imagine. A car breaks down? Maybe $1,500. Unexpected medical bill? A few $1,000s. Job loss? Scary, yes. But unemployment benefits, severance packages, and the fact that most people find new work within 3 to 4 months. These provide real buffers that your brain conveniently ignores when it's running worst-case scenarios at 2 a.m. The scenarios where you need immediate access to $75,000 in cash are extremely rare. And yet millions of Americans structure their entire financial life around those unlikely scenarios. While inflation eats their wealth one quiet percentage point at a time. Here's another mistake I see constantly. People calculate their emergency fund based on their income, not their expenses. If you make $8,000 a month, but your actual necessary expenses are only $4,000, you don't need $48,000 saved up. You need $24,000 max. The other $24,000, it needs to be somewhere else. Working for you. Not sitting there slowly losing value while your bank uses it to make themselves richer. Speaking of which, let's talk about exactly what your bank does with your money, because this part genuinely made me angry when I first learned it. Okay, so here's something your bank will absolutely never put in a commercial. When you deposit money into a savings account, your bank takes that money and lends it out to other customers. At interest rates of 7%, 15%, sometimes 25% on credit cards. And what do they pay you for the privilege of using your money? 0.5%. Maybe 1% if you have a high-yield account. Let me repeat that so it really sinks in. Your bank borrows your money at 0.5%. They lend your money out at 15 to 25%. That spread? That difference? That is their profit. Built entirely on your deposits. You are literally funding their business model, and in return, they give you what exactly? A nice app with a satisfying balance number that feels good to look at? The banking industry has spent billions of dollars, billions, creating a narrative that goes like this. Cash equals safety. Investments equal risk. Keep your money with us. We'll keep it safe. And this narrative is extraordinarily effective because it plays directly into our deepest financial fears. But here's what that narrative conveniently leaves out. Keeping your money in a savings account has a guaranteed, certain, locked-in outcome. You will lose purchasing power. It is mathematically guaranteed. The only question is how much and how fast. Meanwhile, the risky alternative. Investing in a diversified portfolio has delivered positive returns over every 20-year period in modern market history. Every single one. So let me ask you something genuinely. Which one sounds riskier to you now? The thing that is guaranteed to lose value? Or the thing that has never failed over a long enough time horizon? I'll wait. Now. I know some of you are already typing in the comments, but Smith, what about 2008? What about the dot-com crash? What about COVID? And those are completely valid points. The market absolutely crashes. It crashes hard sometimes. But here's what the doomscroll financial news never shows you. The S&P 500 has recovered from every single crash in history. Everyone. The 2008 financial crisis recovered and exceeded previous highs within 4 years. The COVID crash of 2020 recovered in less than 6 months. Patient investors who stayed the course didn't just survive those crashes. They thrived because of them. Because they kept investing while prices were low. The people who got destroyed were the people who panicked, who pulled their money out at the bottom, who let fear make their financial decisions. Which brings me to the most expensive mistake I see Americans making every single day. Let me do some math with you right now. Real numbers, real scenarios. Let's say you have $50,000 in your bank account. And let's say your monthly expenses are $4,000. That means your emergency fund should be $24,000 maximum, which means you have $26,000 in excess cash sitting in your savings account, doing almost nothing. Now, what happens to that $26,000 in 2 different scenarios? Scenario A, you leave it in your savings account. At 1% interest over 10 years, you'd have about $28,700. Feels okay, right? You made $2,700. Scenario B, you invest that $26,000 in a boring, basic, low-cost S&P 500 index fund. At the historical average return of 7% after inflation over 10 years, you'd have approximately $51,000. Let me say that again. $51,000 versus $28,700. You just left $22,000 on the table. Not because of some risky gamble. Not because of some complicated Wall Street strategy, just because you were too afraid to move money out of your savings account. And that's just with $26,000 in excess cash. What if you had $100,000 sitting in your bank? What if you had $200,000? The math becomes genuinely heartbreaking when you run those numbers. Now here's the part that I think about a lot. That $22,000 you left on the table? That's a year of college tuition. That's a down payment on a rental property. That's financial freedom moved 2 or 3 years further away. Just because of one decision. One mental hurdle. The belief that a big bank balance equals financial security. And I want to be very clear about something here. I am not telling you to gamble your emergency fund on crypto. I am not telling you to YOLO your savings into meme stocks. I'm talking about boring, unsexy, incredibly effective index fund investing. Buying a tiny piece of thousands of companies, setting it and forgetting it. And letting time do what time does. Compound interest is legitimately one of the most powerful forces in the universe. Albert Einstein allegedly called it the 8th wonder of the world, whether he actually said that or not. The math doesn't care. The math just works. And the longer you wait to start, the more of that compound growth you permanently miss. You cannot get those years back. That is not a recoverable mistake. That is permanent wealth destruction by inaction. Okay, so now I want to talk about something that most finance channels completely skip over. The psychology of why we hoard cash, because this isn't purely a math problem. If it was purely a math problem, everyone would already be investing their excess cash. The math is not complicated. So why don't people do it? Because our brains are wired for something called loss aversion. We feel the pain of losing $100 approximately twice as intensely as we feel the pleasure of gaining $100. And a savings account balance feels certain. It doesn't move. It doesn't drop. It's always there when you look at it. Investments fluctuate. They go up and they go down. And that visual fluctuation triggers our loss aversion response, even when the long-term trend is clearly upward. Your bank understood this psychology before most of us were even born. Their entire business model depends on exploiting it. There's also something called Parkinson's Law that applies directly to savings. Parkinson's Law says that work expands to fill the time available for it. The financial version is this: expenses expand to fill available cash. The more money you have sitting visible and accessible in your bank account, the more likely you are to spend it. Not on emergencies, on stuff, on things you don't need, because the money is there and it feels abundant, and your brain says, "We can afford this." When your bank balance is lean and purposeful, you become more intentional, more creative, more motivated to actually grow your income. Some of the most productive periods of my own financial life came when I was motivated by leaner cash reserves. Not broke, not stressed, just lean and purposeful. There's a massive difference between financial stress and financial intentionality, and keeping the right amount, not too much, not too little, puts you in that productive middle ground. All right, enough about the problem. Let's talk about the actual step-by-step solution. Here is exactly what I would do if I were starting from scratch today. Step 1. Calculate your true monthly expenses. Not your income, your actual necessary expenses. Rent or mortgage, utilities, groceries, insurance, minimum debt payments. Write that number down. Step 2. Multiply that number by 6. That is your emergency fund target. That amount stays in a high-yield savings account, not a traditional savings account paying 0.5%, a high-yield savings account paying somewhere between 4 and 5%. Those exist. They're FDIC insured. They're completely safe. Just Google best high-yield savings accounts, and you'll find plenty of options. Step 3. Calculate how much you have above that emergency fund target. That is your investable excess cash. Step 4. Do not move it all at once. I know it's tempting to just rip the Band-Aid off, but instead, divide your excess cash into 4 equal chunks, and invest 1 chunk per month over 4 months. This is called dollar cost averaging, and it protects you from the worst-case scenario of investing everything right before a temporary market dip. Step 5. Invest in a simple, low-cost, boring S&P 500 index fund. Vanguard VOO, Fidelity FZROX, Schwab SCHB. I'm not going to tell you which specific one because I'm not your financial advisor, but boring, diversified, low-fee index funds are where the math points. Step 6. Do not check it every day. Seriously, do not. Set it up. Automate future contributions. Walk away. The biggest enemy of investment returns is the investor's own behavior during downturns. If you check your portfolio every day, you will panic sell at the wrong time. That is not me guessing. That is backed by decades of behavioral finance research. Set it. Automate it. Ignore it. Let time work. And step 7. If you have any of that excess cash earmarked for a specific purchase within the next 2 years, keep that portion in a high-yield savings account or short-term CD. Don't invest money you'll need within 24 months. But everything beyond that 2-year horizon, get it out of that low-interest savings account and put it to work. Here's the bottom line, and I want you to really hear this. Your bank account balance is not your net worth. Your bank account balance is not your financial security. Your bank account balance is not a measure of how well you're doing financially. Real financial security comes from assets that grow faster than inflation, from multiple income streams, from investments that compound quietly in the background while you live your life, not from a pile of depreciating cash that your bank is lending out at 20% interest while paying you 0.5%. The wealthy figured this out a long time ago. That's part of why they stay wealthy. Not because they earn more, though they often do, but because every dollar they have is working. Nothing is sitting idle. Nothing is losing ground. Every dollar has a job. I want that for you. You worked hard for that money. Every dollar in your bank account represents hours of your life. Hours you traded for that money. Don't let inflation silently steal what your time and effort built. Keep your 3 to 6 months. Keep it in a high-yield account. And put everything else to work before inflation turns your financial fortress into a house of cards. Your future self, 10, 20, 30 years from now, is either going to look back at this moment and say, "Thank God I made that change," or they're going to wonder why nobody ever told them sooner. I just told you. What you do with it is up to you. If this video changed how you think about your savings, hit that like button. It genuinely helps more people find this content. Subscribe if you want more videos that actually explain how money works instead of just telling you to work harder. And drop a comment below telling me, how much do you currently keep in your bank account? No judgment. I genuinely want to know. And if you want to see the video I made about exactly which index funds I'd look at first, that's sitting right over there. I'll see you in the next one.